Hey everybody, Sean, top producer, the loan officer of the fifth largest bank. Just wanted to reach out to you. Today the Fed is announcing that they're going to cut rates by 25 basis points. What does this mean? Should I lock my rate? Should I refinance? Oh my God, where am I at? What am I doing? So let's try to translate that a little bit. And I actually had to take some time and kind of decipher it and figure out what Fed Chairman Powell was talking about and how it actually impacts you as the customer. Most of my customers are high net worth or private wealth or physicians for the most part, is really where my sweet spot is. And this particular podcast on the Loan Doctor podcast that we're going to post this on is especially for physicians. So why the Fed just created a rare opportunity for you guys to really capitalize on the market and created an opportunity, like what I call a window for high net worth households. First of all, high stakes. You're, as a physician, high income earners, professionals, private wealth, in the next 2 to 8 weeks, okay, you're going to start to see a shift as a result of them cutting rates and also doing some, what I would call moderate quantitative easing, if you will, okay? And there's some reasons why they're doing that. It's not like they did it in 2008 and 9. This is for a different reason. It's more about the tariffs, and it's also more about the tax payments that have to come out on April 15th when everybody was looking to get their income tax checks. So if you're a physician, high net worth, private wealth, the next 2 to 8 weeks is going to be a crucial time, and it's going to be a great time to actually either one, refinance your loan and pay down some debt with taxable deductible dollars. We can talk about that on another podcast. Or two, and number three is just to give what I call a loan consultation on a checkup from the neck up. We usually like to do those once a year, and typically at the end of the year. It's not because the Fed cut the rates is having an impact on the market. It's more about how they went about the strategy and doing it, and what Powell was really signaling underneath the surface of it all when he was saying, hey, you know what, we're concerned about unemployment, and we're also concerned about inflation. Now, understand, Governor Powell, the federal chairman, okay, his job is not to set policy for mortgages. His job is to set monetary policy for two things, and only two things. One is to keep inflation in check and also to keep unemployment in check. So which one of those is the most effective right now? And what they're trying to do is balance those, and it's very difficult when they're both going in the opposite direction. So today I'm going to try to break it down and simplify what's really going on behind the scenes and how it's going to impact you guys. So first thing we got to look at is what Powell was saying, and I'm looking at my notes, by the way. What Powell actually said is the part that matters to mortgage rates the most is tariffs. So tariffs create a temporary inflation, and the Fed offsets it with an easier policy. So what is an easier policy and higher tariffs? So the tariffs are really a short-term pricing spike. What they're looking at is saying, hey, is it going to be a one-off thing where when they go in to put the tariffs in place, are the people that are selling you the goods, are they just going to hold back and they're going to eat that cost, that additional cost, or are they going to pass it on to the consumer? And once they pass it on to the consumer, it's pretty much going to stay there. And right now, we're considering it to be a one-off thing. And we haven't seen that impact yet into our economy. So there is a concern there. What's going to happen when they do it, okay? Financial conditions tighten. Anytime there's uncertainty in the market, we're going to start to pull back as a bank. We're going to pull back and we're going to say, okay, let's look at this before we do anything further. Obviously, we're going to be conservative. And the same thing with the higher end wealth-driven clientele. They're going to look at it and they're going to say, hey, you know what? Maybe I should wait to buy the new car. Maybe I should wait to buy that new house. What's interesting, though, is I'm going to show you why now is the time to look for that new house in the next 8 to 10, probably, I would say 4 to 6 weeks, 8 weeks. So what Powell also said is we're not going to let the tariffs choke the economy. It's less about them making a rate cut, and it's more about the language and the posturing that he's using and what I'm going to call the neurolinguistic patterns that he's using as he's making his speech, and the words, and they're ridiculously careful about the words that they choose to use. Translation for mortgages, the Fed will lean into accommodative and lower rates as needed is what he's really saying. Is they're not looking to blow the market up, but at the same time, they're in a holding pattern for right now. So we're going to start to see that now trickle down, and we're going to see how that impacts. And for the last two cycles, what we've seen is they cut rates by 25 basis points before. They cut them again at 25 basis points. The actual mortgage rates went up initially right after. And then after about a week or so, within a 2 to 3 week period, you'll start to see all of a sudden the dust settles and the banks will actually pull back and they'll actually reduce rates a little bit. So that's pretty much what we're expecting. But let's call it quantitative easing for a lack of a better word, or softening yields. It's what they will call a quantitative slowdown, if you will. More liquidity stays in the system. So what they're trying to do is, by offering to buy treasuries and stuff and taking them off the books, they're putting more cash into the system, which is going to put less pressure on the market. So Powell is hinting at what they really want to do is they want to reduce the treasury roll-offs, okay? And what that means in English is less quantitative easing, more cash in the system, and less volatility. And also it lowers the bond yield because there's more cash in the system. It basically intrinsically, people are willing to pay less for it because there's more of it, and it's supply and demand, if you will. If there's more cash in the system, they're gonna pay a little slightly less for it. So that means that the mortgage rates are going to be slightly less also. With that, mortgage rates are going to actually drift down as the liquidity increases and there's more supply. The rates are going to slow down a little bit and they're going to calm down a little bit. So April 15th, you mentioned April 15th. What does that have to do with my mortgage, or what does that have to do with liquidity? The funny thing is April 15th is one of the biggest liquidity drains on the system in the entire year, because the Fed they're actually going to say, in his words, he says pre-committing support. He's putting some money aside, so when you go and want to get your tax check, it'll actually be there to go get it. And when they're doing that, on tax day, it always sucks the liquidity out of the market and out of the money markets. And what he's saying is, hey, we're going to backstop this a little bit. We're going to fund the market. We're going to put some cash in there. So when you guys go to get it, it's actually there. And why you should care about this is when that happens, the spread between the money and between the short-term rates and long-term rates and the cost of funds, if you will, okay, that spread actually loosens a little bit and people feel a little more safe and they're a little more risky and they're willing to be less conservative, if you will. And what that means is that banks and institutions are going to reduce rates to try to stimulate people to make a decision again. Okay, and especially because they can get the funds slightly cheaper. So if they can buy the funds slightly cheaper or borrow the funds slightly cheaper, they're going to give it to us at a slightly cheaper rate in a mortgage. So safer for the banks, more conservative. It turns into, hey, you know what? We can give the money out a little bit cheaper. So what's the key distinction for what I'm going to call high net worth or wealthy clients must understand is mortgage rates don't follow the Fed rate. Because the rate is cut by 25 basis points, like I said, in the past two cycles, they cut the rate 25 basis points. The actual mortgage rates on a 7-year ARM and a 30-year fixed rate mortgage actually bounced up a little bit by about 20 or 30 basis points, which is historically not supposed to happen. But because of the economy we're in and because of the very sensitive situation we're in now, rates don't actually follow the Fed movement, not exactly. What happens is it takes a little bit of time for the Fed strategy, which is they reduce the rate, but they also are now going to put an influx of cash into the system, which is going to take some time for that to kind of balance out and for the dust to settle, if you will. And bear in mind, we're putting money in the system now for April 15th. We're still in December. So it's going to take a little time for that to unwind, and that's why I'm saying in about over the next 2 to 6 weeks, you're going to start to see rates slide down a little bit as that influx of cash starts to come in. We now understand mortgage rates don't follow the Fed's chairman, but they do follow the liquidity in bond markets. Bottom line is, when we go to give you a mortgage, we're going to look at the 10-year treasury and we're going to figure out how much it costs us to back that instrument that we're going to give you. So if we're going to give you a mortgage for a 7-1 ARM, we're going to use a 10-1 or a 10-year treasury bond, and we're going to go buy the coupon to basically guarantee that we can give you that rate at that price. And, what's interesting is now there's liquidity, that does impact the bond markets. Yes, or I should say the Fed chairman doesn't set monetary policy, but in essence, they do follow each other very closely. And really what happened is that the Fed chairman really just pushed on 3 different levers in liquidity at the same time, as opposed to just one. So the first one is he lowered the volatility, made it less scary and put less risk into it. What they also did was he put more systemic cash into the system. He put more cash flow into the system, which means if there's more cash, there's less risk and there's less demand, which means that we can actually give the money out a little bit cheaper because we can borrow it a little bit cheaper. And then lastly is they put more stability into the funding markets, which again, they put more cash into the market, which means that we can get access to that cash and we can get access to it at a slightly cheaper rate and we can give it to our customers at a slightly cheaper rate. Now bear in mind, I work for the fifth largest bank in the United States. And really, we're in the business of depositors, and we're in the business of providing more service than just a straight up mortgage company. If you were to deal with some of the brokers, if you will, of the world, I'm not going to mention names on here, but if you went to some, like, I'll give you like one is like Quicken Loans. Let's say you went to them, or you went to Guaranteed Rate or one of those. They're brokers. Your only business is to give you a loan and make money on how much they lend it to you for and how much they borrow that money for. With us, we have CDs, we have short-term stuff, we loan for RVs, we do loans for your child's savings, student loans, all kinds of crazy things that those mortgage brokers don't do. So how does this all wrap up, and what does it start to look like it's what they call the mortgage-backed securities. It's when they're selling off those loans. You remember this from like probably in 2008, 9, when the mortgage-backed securities, actually that market imploded, if you will. What happens is the mortgage-backed securities, the spreads start to tighten a little bit. The 10-year yield falls, mortgage rates drift down a little bit, and over the next 30 to 60 days, you're going to start to see that start to happen. And this is the part almost no borrower understands. And I'm going to say that again. You're going to be the genius in the room when you go to have a conversation with your friends about your mortgage, and after talking to me and after listening to this, you're going to be the smart guy. You're going to understand it because, this is where you're going to shine as the expert. Okay. What's going to happen is, what does this mean and what happens to rates next? Okay. So here's my uneducated prescription. When I say uneducated, I've been in the industry for over 30 years. I'm not an economist, but I've been in the industry for 30 years, and it's been my entire life. And I make it a point to try to break it down so that you can understand it as best as possible. And really what it means is, here's what's going to happen in my professional educated is we can expect the rates to start to move, and they're going to start to move down based on the structure that they put in place. And that's the whole mentality is, let's take, like I said, put more money into the system, which means that we can now get it cheaper. Take the risk out. So what does that look like over the next 7 to 10 days when the dust starts to settle? You're going to probably see where that 25 basis point impact is going to see, you're going to see a rate change of about 1/8 of a point, because the Fed, the FOM rate cut, even though it's 1/4 of a point, it's not in direct correlation to the mortgages, like I was saying. But over time, and with the other pieces of this puzzle and this, what I'm going to call triple play strategy, if you will, we're going to start to see that play out. And in the beginning, it's probably going to be about 1/8 of a point is what you're going to see in the rate. So if your rate was, let's say if it was 6% today for a 30-year fixed rate mortgage, you're going to probably see it in a week or so. 2 weeks, you'll probably see them come around somewhere around the 5.875 with no points, right? The next thing is that over the next 30 days, while that starts to unwind, and we start to go into the new year, and we start to have cash, and we start to have people looking at how much they're making on their tax return and what they get their year-end bonus, right? They're going to start to want to spend more money. And as they want to spend more money, and as now what's happening is that liquidity thing that they were talking about going into April, and they're starting that quantitative easing is starting on December 12th in anticipation of the 15th of April. But as that starts to happen, about 30 days from now, you're going to start to see that 1/8 go maybe to 1/4 of a point, where your rates on a mortgage will probably be somewhere around 5.75. Okay. Lastly, now that starts to pan out even a little bit further, and we get about 60 days away from today, and we get closer to that April mark. We get toward the end of the first quarter. We're probably going to see it about anywhere between 3/8 of a point of an improvement. And that's if inflation cooperates with us. If inflation still stays settled down, you're probably going to see where the banks they're going to push that money in at a little bit of a cheaper price, because they're going to have more liquidity. They're going to have more cash on hand. They're going to have less risk. And as long as inflation isn't going crazy, creating that scare of, oh my God, where are we going? And as long as unemployment is under control, we should be good. And bear in mind too, for the last several months, we had no real data from the government. We were speculating on what the data would be, and we were making some assumptions. And if you even listen to Fed Chairman Powell, he was saying, hey, we're going to get a bunch of data over the next couple of months, and we're going to have to adjust for it because we didn't get some data for the past couple of months. So when we get the new data, it's going to be a little skewed. So what does all this mean? It's just understanding where we're at. But it's not dramatic, but it's huge as far as meaningful and understanding where it impacts you. So where does it impact you and how does it impact you, and whether you're buying, selling, refinancing, trying to reduce debt? And I'll explain this. There's a misconception of having a 3% rate. When I talk to people and they're like, oh my God, I have the 3% rate and I don't want to get rid of it. And I'm like, okay, you have a trophy rate, which is fantastic. The challenge is the average American right now has $247,000 in equity in their house. They also have $90,000 in personal debt. And that $90,000 is at an average interest rate of 19.5%. So even though you have a 3% interest rate over here, and by the way, you get a tax deduction on that 3.5% on the money you pay toward all the interest on the loan because it's your primary residence, and up to $10,000 on the money you pay toward your property taxes. Over here, those liabilities for $90,000, you get zero tax benefit when you pay that money back. So if you're just paying back the interest, in most cases, that's what a lot of people are doing. They're treading water. But if you took the money out of your house and maybe took an interest rate of 4.5% or 5% and took $100,000 out of here and paid off all this debt, you're actually paying it off at 62 cents on the dollar because this money over here is tax deductible. You're now paying off all those liabilities in one chunk, and you're going to pay it back here at 62 cent at a discount of 38 cents. So when people talk about why would I refinance a 3% rate, that's why. I've helped people go from having a $2,000 a month mortgage payment to increase it to $3,500. But at the same time, when they had the $2,000 a month mortgage payment, they were paying $5,000 in personal debt. They no longer had the $5,000 a month they were paying in personal debt. And a grown man who was in his 60s was crying on the phone, and I was like, oh my God, are you okay? He goes, I never thought I would get out from under it. So, understanding the power of how to use what I call, and this is where we set ourselves apart. There's people in our industry and they say, hey, here's the rate and here's what we can do for you and here's the product. Let me know when you find a house. We don't do that, or I should say, I don't do that. I pride myself on building a wealth building loan strategy. I'll say it again, a wealth building loan strategy. How do I get the lowest possible rate with the least amount of bank fees and the highest amount of bank credits or incentives, if you will, for doing business with us, to give you the best deal possible where you're using your money to your best advantage. So what else does all this mean for you? Better buying power with rates come down. The bottom line is the math, right? Higher cash flow on other acquisitions, because when rates come down, that means that your payment comes down with it on the same acquisition price, which means that inherently you can actually pay a little bit more for the house. And by the way, when rates come down, eventually what follows is 60 to 90 days later, prices will start to go up as a result. Okay. So why is this a window of rare opportunity for high net worth borrowers? When banks loosen up before mortgage rates bottom, so what happens is that the prepayment risk stabilizes, right? We're not so concerned about that. The volatility in the bond market drops. Funding markets normalize because they're not scrambling to find cash and they're trying to get cash again, right? Or they're trying to meet their compliance needs, right? So all three of these are happening at the same time, which is like the perfect storm in my world and your world too. If you're in that market, you can actually secure today's rate and still capture future savings if the rate continues to drift down. U.S. Bank offers something very unique. We will actually lock your rate, and if that rate, while we're in that lock period, so if I lock your rate for 45 days between now and the time you're going to close, and the rate drifts down more than 25 basis points on the advertised rate, and we advertise our rates right on the open market. You don't have to go digging for them. You don't have to put in your firstborn child's name and number and their weight and foot size. You could just go on our website and pull it up and look at the rates for today. If that rate comes down more than 1/4 of a point from what I locked your rate at, we can actually offer to try to renegotiate your rate with our secondary department. Our company will offer you to renegotiate that rate to keep you as a customer. Other companies are going to charge you for the luxury to do that. They're going to say, you know what, we locked it, we took the risk, and now you have to pay for it if you want to renegotiate that. So that's a massive difference between us and the other companies out there right out of the gate. I find it hard pressed to find somebody that's going to be able to break down what I just went through to help educate you and to take all this information and digest it down to a point where, what does it mean to me when I'm trying to buy a home? How do I actually build a wealth building loan strategy? What does he mean by that? And I think we've illustrated that pretty carefully. So strategic opportunities on the personal wealth side, here's where you make the shift. And, the market is going to support that. In the cash out refinances, like I said, discounted dollars, you're going to be paying back personal liabilities. Maybe in student loans, you might want to choose to do it with the cash from property that you already have. High net worth borrowers, you're going to pay off your personal liabilities at a discount. You can consolidate debt and make it a lot easier. You can unlock capital for investments. What do I mean by that? I have a customer right now. We're going to take out $200,000 out of his primary residence that's just been sitting there getting zero interest and paying zero interest. And we're buying a second home for him and his wife, and they're going to use it as an Airbnb until they get to retire in about 3 years from now. And that actual investment is right now projected to make them somewhere in the 15 to 20% return on their investment, but yet the money is only going to cost them, after tax benefits and everything else, probably around 5%, 6%. Money in, money out, I'm not a genius, but I do know that 13 or 15%, if they're accurate, where the realtors are giving them those numbers, and that's not me, but let's say they're half right and they get 10%, 10% is more than 5%, and it's tax deductible. Awesome. So what else? The other thing is lower volatility. At the end of the day, really what we're trying to do is help you to purchase a home, invest in real estate, or take the real estate you already have and leverage it as best as possible and get your money to work for you versus working for your money. Mortgage dollars, especially in an easing cycle, are the cheapest dollars available, because that means that whatever the money is that they're putting out into the market, the government is backing it and are actually putting more money into the system, and they're flooding the market with cash to make it so that money is actually cheaper to buy or to lend out, if you will, which means that it's cheaper for you to borrow. So buying or upsizing, it's going to create more inventory in the market right now, because, by the way, you listening to this are going to be ahead of the class. The real estate business takes anywhere from 60 to 90 days before this information actually hits the tape, as they say. And in the stock market, they call it buying the rumor, selling the news. If I tell you today that, hey, your neighbor's house sold for $100,000 more than you thought, you're going to wait 2 months for that property to close before you're going to find out if I'm accurate or not. But if you had the inside track, you may make a decision on putting your house on the market and capitalizing on it also, if you knew that there was that much opportunity. So inventory, though, for the time being, is a little bit stagnant. It's a little bit in a stall pattern because we're in that uncertainty phase. Now that we got clarity, it's going to start to take off like a rocket. Rates come down, prices go up. So if you're going to do something, do it now. Right now there's less competition. You're in a position to negotiate with leverage. You'll understand that after talking with me, maybe I should pay a little bit more because you marry a house and date the rate. Say it again, marry the house and date the rate. When you purchase the house, whatever your acquisition price is doesn't change, but the rate can change. If the rates come down, I could refinance it. So today's maybe 5.5%, and then I'm going to call you up and say, hey, by the way, I can give you a 4.5% rate if the market cooperates. The other thing is future refinancing. It's already baked in. Typically, people ask me, what does it cost to refinance? Ideally, with us, it's about 0.5% on the loan amount. So why do I say that? We want to keep you as a customer. Remember what I said, we're a bank. We're going to keep your loan. We're not going to sell it off to somebody in most cases. We want to keep you as a customer. And so what we're going to do is try to make the refinance as painless, as easy, and as affordable as possible, where it makes sense for both of us to do business together. Let's face it, cap rates stabilize faster, and when there's a mortgage in place, your cap rate on a property is pretty straightforward. How much do I put in? It's a math equation, right? Cash flows improve as rates drift down. So if you do buy an investment property and it makes money, let's say it's making 8% return on an investment now. If the rate comes down and it comes down by 0.5 or 0.75% and we refinance your loan, that means your carry cost is lower. That means that effectively your return, your investment just went up exponentially. Lastly is locking prices today. Why would I lock today if I think the rates are going to continue to come down? You want to lock today because remember what I said is if the rates do continue to come down, we're going to be able to renegotiate your rate one time for free. But what it's going to do is you're going to be in a position to where It takes time for me to put an application together, and it takes time to get all the ducks in a row. But if we're already in the row and we have their iron is red hot, ready to strike, rate comes down, boom, I call you and I say, hey, Mr. Jones, we're going to lock your rate today. Right? What's the big macro effect of this whole mess? Advantage for people of high net worth, if you will. Fed environments, like if you wanted to make investments, if you will, or you wanted to put this into a strategy on Wall Street, Fed environments support home builders, regional banks, REITs, mortgage cycles, how they go, meaning that if you're going to play options or something like that, you may want to consider that. I'm not telling you to do that, but I'm just saying to you that those are the things that it impacts. And at the end of the day, we've been talking about this for a year. In May of next year, more than likely the new administration is going to try to put somebody in there that wants to support their desire to push down on rates and push down on them substantially. I don't care if you like the new administration or hate the new administration. The bottom line is they're going to put somebody in there that they can push around. They're going to stand on that person's shoulders until they make the rate change. And when they do, it's not going to be because of inflation. It's not going to be because of employment. It's going to be just so that they can say, hey, look at me, I did it. And they're going to be banging on their chest. And that's going to be an opportunity for us to talk again about getting to what I'm calling the absolute lowest rate if possible. Closing thoughts, concierge strategy over slinging loans and slinging rates. I implore you to talk to a professional that can help you. At the end of the day, the vast majority of my industry doesn't fully understand what we just talked about. And the reason why is mortgage people are really good at what they do. The realtors are really good at what they do, but they don't have 30 years of experience on being a realtor for 25 years and coaching and mentoring and being a consultant to the mortgage industry for 10 or 15 years. And now being a full-on mortgage loan officer, one of the fifth largest bank in the United States and one of the top loan officers in a very short period of time, which is unusual. But it is unusual for you to get all that information in one place and to have somebody distill it down to where I can say to you, now's the time to buy, or now's the time to look at your loan and have I call it a checkup from the neck up. Let's have a loan consultation for the end of the year and figure out what we can do. Hey, doc, you're on a great path. Keep going forward. How's your pickleball? How's your life? How's your golf? How's your family? By the way, your rate is X and you should just stay the course, or your rate is Y and we can save you some money. I've done this now for multiple physicians that not only own their primary residence, but I've also been able to help them reduce their rate substantially on their investment properties. If you want to understand how the window, we can actually capitalize on that window of opportunity for you, you're just going to reach out to me. We're going to look at the numbers together, and either it works or it doesn't. My role is really simple. It's to help you optimize and leverage, reduce your cost of capital, and help you build a wealth building loan strategy and make a decision confidently, with confidence and clarity, that you're getting the best possible deal at the lowest possible rate with the least amount of fees and the highest bank credits, and you're getting white glove service and I don't tell you this to impress you, I tell this more to impress upon you. You're getting white glove service with somebody who has 30 years of experience, that's been on Bloomberg News, Bloomberg Radio, NBC, CNBC, all those different news channels. Tell that to say to you that if they put me on those channels, and that was probably 10 years ago, I've only gotten better as I got older. I didn't get gray hair by accident. I have 2 kids and a dog, and a wife. But no, on a serious note, listen, I can't wait to help you to get to the next point in your life and your mortgage process. I'm here for you. Again, my name is Shallis, top producing loan officer, the 5th largest bank in the United States. By the way, I just want to thank my senior management for always supporting what we're doing here, the Loan Doctor podcast. I can't wait to help you. We'll see you on the other side. Again, I'm sure you got questions. Just reach out, set up an appointment with me, set up a time. I'm happy to talk to you. Over the next couple of weeks, watch for Rosie the Rate Guardian getting launched. She is going to be your watchdog for your rate. And when I'm sleeping, she's going to be watching your rate, and she's going to poke you if there's an opportunity for you to save some money, or if your rate starts to spiral out of control going the other direction, she may poke you too and say, hey, you know what? You should talk to Sean and look at this. We'll see you on the other side. Have an awesome day. Talk to you soon.